So here it is. We have successfully finished our chapter CVP analysis or cost volume profit relationship. So I have a very nice video which shows the CVP analysis in practical scenario. So let's see on our next slide.
We use contribution margin as an important analytical tool. While it's not necessarily good regular general accounting, it's imperative that you use a contribution analysis when you're looking at opportunities to take perhaps lower priced business or continue product lines or add product lines. Sourcing decisions or source versus manufacturing decisions are often made with contribution margin analysis.
One of the most common applications of cost volume profit is in break-even analysis.
Boeing, before they decide to launch a new aircraft, what they do is they make an estimate of what the costs are going to be launching that aircraft, and there's huge costs up front. And those can be thought of as a fixed cost of the project. Given how much we think we can sell this aircraft for and how much it's going to cost us to produce each aircraft, and the fixed costs we have, how many of the things would we have to sell in order to actually break even, to recover our initial investment in that?
For telecom technologies, break-even scenario may actually be a plus because of intellectual property.
If I see a business plan and my planning people says, John, if you let me develop this, you're going to have this product, we will have a guaranteed sale, and worst case scenario, you're going to break even. As long as I'm hearing that we will retain the IP, and IP is the intellectual property, if I hear that word, that we will break even and I will end up with IP, I will say go. From my side, I have this IP in the library that I will use to develop another product next time, or I can sell it.
The break-even point is the point where total contribution margin equals total fixed expenses, or where total sales revenue equals total expenses, fixed and variable. At the break-even point, profits are zero. Mathematically, it looks like this. Sales equals variable expenses plus fixed expenses plus profits. Since profits are zero at the break-even point, it can be computed as the point where sales equals variable expenses plus fixed expenses. Let's do the math. At Antware, the unit sales price is $24. Unit variable expenses are $18. Therefore, 24x, where x is the number of units sold, is equal to 18x, the variable cost per unit, plus 3,000, our fixed cost. 24x minus 18x equals 6x. 6x is equal to 3,000. X equals 500 is the break-even point. 500 is the break-even point in units sold. Since our unit price is $24, the break-even in sales is 500 baskets multiplied by $24, or $12,000. Our variable costs are $18 multiplied by 500 baskets, or $9,000. To get to our contribution margin, subtract variable costs from sales revenue, and we get $3,000. Since our fixed costs are $3,000, our net income is zero, which proves 500 baskets is our break-even point.
A break-even analysis helped VF Corporation discover that producing a product line at a low profit margin was a sensible thing to do, at least for the short term.
Break-even analysis is effectively what the contribution analysis provides us. We did one recently where we evaluated a product line that sells at very low standard gross margins. However, it's a product line that we manufacture the fabric in-house and we sew it in our sewing facilities. It's providing contributions to fixed cost of both our fabric mill, our sewing operations, and in fact our decorating operations too. So although the product didn't look profitable, we realized that we're much better off by running this product at low margins and selling it through discount channels in order to utilize our fixed cost effectively.
Okay, so I mean, most of this is driven by sales reductions. Is that?
The potential impact on profits of changes in fixed costs or variable costs and in projected sales volume can be determined from CVP analysis.
had it not been for these external influences, this is what the number would have been.
Sure.
Many managers use graphs as a tool to get an overall picture of how profits change with changes in volume.
Let's construct a graph. Drop in the volume of baskets on the horizontal axis and dollar values on the vertical axis.
The fixed expense line is drawn at $3,000. We get the total expenses line by adding variable expenses to the fixed expense line. Last but not least, we draw the total revenue line beginning at 0.
We can plot the break-even point for Antware, which is 500 baskets on the horizontal axis and $12,000 on the vertical axis.
We can use this graph to show that our break-even point is where the total expenses line crosses the total sales revenue line.
You're right! The vertical distance between the total expenses and sales revenue lines is the expected profit or loss at any given level of sales volume. Let's show the loss area in red and the profit area in black. The point where the two meet is our break-even point. See, they meet at a volume of 500 baskets.
Graphs provide a quick visual thumbnail sketch of cost-volume-profit relationships and are useful for presenting such data in a group setting. VF Knitwear uses graphs to support the objectives of their presentations.
A graph is a good form of overview and summary. I don't think decisions are made off of graphs, but I think it does give people a sense of perspective and can help support the stated mission or the objective of the presentation. So graphs are generally included in most of our formal presentations as supporting documentation.
We use them a lot for trend analysis, particularly cost and how our costs are behaving and in which direction they're going.
Well, I have to say that you ants run a good business.
And it's about time for me to get back to running the business. That's all from me for now.
One way that organizations differ is in their cost structures. Cost structure refers to the proportion of fixed costs to variable costs. A company may have high fixed costs and low variable costs, or vice versa. Businesses that typically have high fixed costs are heavy manufacturing companies, such as those that produce automobiles, planes, and steel. This is because of the extensive amount of capital required to manufacture these products. Businesses that typically have low fixed costs include restaurants and other types of service companies. These companies rely more on direct labor and materials than mechanization to provide their services.
Cost structure can affect how volatile your profits are. If you have two companies that make exactly the same thing, and let's suppose that they have exactly the same total cost for a given level of production. However, one of the companies has very high fixed costs and very low variable costs, and the other has the opposite situation. Then what will happen is the company that has very high fixed costs and low variable costs will also have a very large contribution margin per unit if they have low variable costs. Now what that means is if they have an increase in sales, in unit sales, their profits are going to go way up. If they have a decrease in unit sales, their profits are going to go way down. Now the other company that has lower fixed costs and higher variable costs will have a smaller contribution margin per unit, and so the effects of volume changes are going to be much smaller on the profits of the company. So in general, if a company has high fixed costs and low variable costs, the profits are going to be much more volatile than for a company that has low fixed costs and high variable costs.
The impact of cost structure on profits may be gauged by the degree of operating leverage. The degree of operating leverage shows how changes in sales change profits. Companies which have a high proportion of fixed costs to variable costs have a higher degree of operating leverage than companies which have a low proportion of fixed costs to variable costs. So this means a high fixed cost company's profits change dramatically as sales revenue changes, whereas the profits of low fixed cost companies change much less in response to change in sales. The degree of operating leverage is calculated as contribution margin divided by net income. At Telecom Technologies, low variable costs mean dramatic increases in profit once fixed costs are covered.
Because most of the time our first sale would cover our fixed costs and our variable cost is only 10 to 12%, the second and the following sales would add 88 to 90% directly to your bottom line. So every next sale helps us a lot to cover the cost, first one, and then to add it to the bottom line and basically fund the future R&D. So it's a huge multiplier, so it helps us a lot basically.
When considering cost-volume-profit relationships, it is important to think about the optimum combination of costs, selling price, and sales volume in terms of unit contribution margin, the break-even point, the contribution margin ratio, and the sales mix. Trade-offs are possible between types of costs, as well as between costs and selling price, or between selling price and sales volume. Sometimes these trade-offs are valuable, sometimes they're not. CVP analysis provides you with a powerful tool for identifying those courses of action that will improve profitability.
Okay, here is our assignment 3. I will be uploading our assignment 3 on the Blackboard and WeChat group as well. Please do remember our due date. And here it is. So here is the end of our lecture. If you have any question, any queries, please do write us in our Blackboard discussion group and also our WeChat group, which is Managerial Accounting CIP 2020. And I will be answering your queries over there. And also, we will be having a Zoom live discussion as well. If you have any query, please do write while having this lecture, and we're gonna discuss in our Zoom live discussion as well. Okay, take care. See you with another exciting chapter. Until then, stay safe. Take care. Bye bye.